My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Jay Singh, the man known as the special situations expert on Twitter. I've spent the last half an hour or so listening to some of Jay's great spaces that he himself runs, and I'm actually very much looking forward to this back and forth conversation. Jay, I was sincere when I said that. I think a lot of what you bring to the table is really quite powerful, and maybe it's confirmation bias because I tend to agree. But introduce yourself a little bit to the audience. Who are you? How'd you get interested in markets? What have you done throughout your career? And what are you doing now?
Absolutely. Well, thank you for the introduction. Over the past 20 plus years, I've been very passionate about the markets. Actually, grew up in New York, son of two immigrant parents from New Delhi in India. They came, my dad was a physics chem major, mom was a poli-sci major. They came to the US without any, US education, didn't have money to really go to school. So my dad actually lived in the basement of a restaurant in Hell's Kitchen. One of the first two Indian restaurants in New York. And as soon as he was able to get on his feet, we moved to the suburbs, and essentially from a really young age, we had in school, these stock investment clubs. So even in high school, I was doing that, and then I got an opportunity to work as a temp at Citigroup Asset Management, where I was installing Bloombergs for big portfolio managers and traders. And when they dropped coffee on their keyboard, I would replace it. That's how I really learned about finance and investing in a deeper way, because my family had no connections. They didn't even know how to fill out college applications. I ended up going to school on a full ride. I owe it to my advisor in high school. Otherwise, I would have been going to community college. But in school, I worked six jobs. I essentially was working at one of the first international equity quant hedge funds as a risk management assistant in the mornings from like 6 a.m. to 10 a.m. I would go to class, and then they had a counsel, a legal office. I'd go work at the law firm at night. They had a socially responsible investing arm, it was called KLD Research and Associates. It's now called Morningstar. So worked with them on the SRI side, with the Knights of Columbus, helping them find investments that fed their ethical needs. Was writing about fecal coliform bacteria in the Charles River in Boston for a biology magazine, and was doing a bunch of work study jobs back then. And you know, by that time, I was trying to pay off my mom's mortgage and find a job on Wall Street, because that was the only way to dig my family out of the hole that they were in terms of the debt they had, and just all they spent trying to raise me and my two brothers. So finance was a way out for me, and it allowed me to really build a passion for the capital markets and understand why they exist. Spend some time in banking, spend some time in private equity, for essentially the maternal grandson of the founder of IBM, Thomas Watson. Spent some time, on the merger arb side at Goldman, at the same desk where, Dinakar Singh and Daniel Ock of Ock-Sif came from. Moved, during the financial crisis into a role where I was focused more on distressed debt and bankruptcy. And while I'm not a lawyer, I learned a lot about how to read a disclosure statement, how to read a plan of reorg, how to read a docket, how to put together a capital structure, and that transitioned into capital structure arbitrage and convert arbitrage after the high yield market rallied in 2009, 2010, 2011. That, segued into REIT and MLP conversions, spinoffs and split-offs, equity event-driven trading. And it led me to, start my own company that I sold, and then retired until essentially COVID, where I saw an unbelievable opportunity to buy securities at big discounts to net asset value, whether it was, closed-end funds, whether it was, converts, which are unsecured bonds with essentially call options, or hybrids at big discounts, which, I've started that now. You have a database of 700 hybrids. And there's some really interesting opportunities in that space with fixed to flip preferreds, where essentially you can buy a preferred, let's say with a 6% coupon, and it's switching to, let's say, a LIBOR plus 5. front 3-month LIBOR is at 4%. So you have like a 9% coupon. You buy that at 70, right? On a 25 par retail pref, and you're making a very high double-digit total return. And if things pull apart and rates change, you could have an 80% type return profile and not even take common equity risk. So those types of trades were really interesting during, really the 3 months where the market was out of whack at the outset of COVID, and then I used those opportunities and started to buy common equity in the companies where I was able to find names where their converts and prefs were in distress. And the interesting thing about the hybrid market, which is where I wanted to focus on today, is that if you look at the default rate on the underlying companies, because a lot of the underlying companies have real assets, whether they're MLPs or they're REITs or they're banks that are systemically important, the default rate on the hybrid market is actually lower than the high yield bond market. So, one thing I wanted to share on the call is there's more than just stocks, right? I think predominantly on FinTwit, I would say most of the investing public is focused on, stonks, STONKS. And within that asset class, they're focused on either the FANG or extremely risky securities, whether they're microcap or they're unprofitable tech. And, the market goes through regime changes. So, in every decade of the US market's performance, your best bet would have just been, if you don't have time to index in the S&P 500 index fund, or after Jack Bogle with Jack Bogle at Vanguard, or when index ETFs were started with the Spider in the 90s, to invest in that. But if you didn't do that, you take a step back, every decade had a different asset class leading returns, whether it was the Nifty 50, whether it was private equity, whether it was tech stocks, whether it was commodity and emerging markets. It was FANG for the last 15 years and growth. So I think it's a little bit naive. I think people just tend to get stuck in what I call the church of what's working now. And when you get stuck in the church of what's working now, and you get stuck in that regime, you end up really destroying capital in like the regime that comes after. I'll give you a few examples. So I had a lot of friends in the early, after the dot-com bubble, that really got into emerging market investing without understanding emerging market risks. So, investing in emerging markets, I'm not saying it's a bad thing, but a lot of these markets face, fat tail leptokurtosis. And what that essentially means is that, you can get into a situation where, when you invest in an emerging market, you're not just investing in the equities of that country, you're investing in the currency and the interest rate regime. And you have to understand, what the deficits are, how stable the currency is. And you could really get stuck in a doom loop where, for example, my had friends who got burned in the Turkish ETF. They thought they were buying it cheap PE ratio, didn't realize that the Turkish lira could fall through the floor. And, who was running the country, what his political agenda was. So, while these individuals made a lot of money after the dot-com crisis, riding the EM rally, they ended up losing everything because on a relative basis, the S&P 500 outperformed every emerging market in the world by a couple 100% coming out of the great financial crisis. So, and then with the tech, with the tech bubble, what we ended up doing, after things ran from COVID through mid 2021, was we started to short unprofitable tech. So there's a huge bubble in what they call the SPAC space. Been following the SPAC space for a couple of decades. It was less than a $10 billion industry, and it grew to a $200 billion industry overnight. Part of the reason is, CEOs, management teams wanted to get liquidity. They're kind of shocked by the events that happened. Wall Street started to use this asset class and target high net worth individuals, family offices, as a way to, preserve capital, because they're essentially a net asset value where you could vest. And these SPACs were investing in, essentially 6-month treasuries or money market securities. So there's very, very little risk. And you had this free option so that if they announced a definitive agreement, they would rally. So that model made sense to me. I was invested in a number of SPACs and had made some money on the way up. But then I realized some of these started trading at big deviations from NAV well before you even understood the dynamics of the deal. And one thing that really shocked me was that people didn't understand the capital structures of these companies. And right after the deals were announced, within 45 days you would have an S1 pipe unlock where sometimes warrants and shares of pipe investors could be several 100% of the actual float. And one of the first names where we were short, where a lot of people got burned, was in Lucid. And it was simply on the catalyst where intraday the name was down 25%. And if you were short and covered or using options, it was just a phenomenal asymmetric return because people didn't understand, how these things work. And then, that they're forced sellers that, want to essentially lock in gains. And these are, essentially hedge funds. And, these hedge funds were essentially trying to take advantage of retail investors because they would get in at a discount through a pipe, a public investment, in a private investment in a public equity, and they would get maybe 15-20% valuation benefit through extra warrants and shares versus the public. And the public had been looking at SPACs for 2 years and saying, hey, they only go up. And that regime completely blew up because, like every asset class, there's too much money that ends up following it. And, you can take advantage of overvalued names. On the flip side, what ended up happening here was because it was so easy for hedge funds to participate in these pipes and sell out of their shares before retail knew what was going on, hedge funds pushed more and more capital towards the pipe. Well, obviously, the bankers are going to accept that. The underwriters like Cantor and Cowen, they were making 20% on the other side. So they were like, okay, we'll take pipes. Let's grow pipes so large that the sponsor and the manager on the other side can grow their valuations to 2 to 3 times what the private valuations were. And at that point, they just assumed the market was dumb. And the market isn't dumb, right? The market speaks the truth. It might be delayed, but over time, these valuations, especially for some of the unprofitable names, have come down 90%. There's a name called Cores that we were short and we covered early in the crypto space that is down now 95% filed for bankruptcy the other day. And it's in a period of less than a year. So, the point of that is just saying that, with a lot of regimes being in the church of what's working now, if something's hot, something's interesting, if your friend is telling you about something, it's probably too late to get involved. Right. And, having a balanced approach is the best way to do it.
Yeah, no, and there's a lot of different directions I want to go back and forth with you on. So, but I want to go back for a moment to the upbringing because you mentioned both your parents, were immigrants. They came here, had to learn the culture. Both my parents were from Egypt, and same dynamic. I was born here. They had to learn the culture, the language, and it sounds like no different than my parents. Your parents were extraordinary hard workers. I want to hear your thoughts on as somebody who's from an immigrant family, how you think about work ethic, because everything that you've described in your career indicates to me that you're an extraordinarily hard worker. You keep pushing forward. I like to think of myself the same way, but a lot of that does come from our parents.
Oh, 100%. It comes from, the way you were brought up. I was supposed to be retired, and now I'm managing the team of 9 analysts in pseudo retirement. And we have institutional clients. Some of the big guys like Millennium. We also cater with the same research to individuals. And it's the amount of work being up till 2-3 a.m. doing this stuff. I'm doing it mostly because it's fun, and it also helps inform my own education and my own decisions. But my parents, were working. Both my parents were working, like you, immigrant parents. I was born a citizen, proud to be a U.S. citizen. I like to think that the American dream is still alive. But my parents were essentially, my dad started his own business trading scrap metal. He would essentially trade scrap, and there was a point in time where that business was doing well, but Bank of Tokyo Mitsubishi, came involved, and Korean scrap companies really undercut him on margins, and that business just went away overnight. He started to do a business with PepsiCo World Trade, where he would essentially deliver like mango juice and aged rice to Indian restaurants as they were growing in New York. And PepsiCo basically lied to him and undercut him because he wasn't growing fast enough. So they started selling to his clients and started selling him products that weren't aged properly. And believe me, this happens with big companies, and they pushed them out of business. My mom was working as a school teacher for I'm trying to think of the politically correct way to say it, but she was working as an aide for kids that needed extra help in the public school system, and she wasn't treated very well by any means. And my dad essentially became a real estate agent. That's a tough job for someone with brown colored skin in the U.S. in this 70s, 80s, and 90s. So you know we faced a lot of discrimination, obviously bullied at school, but it makes you tougher, right? That work ethic makes you stronger. What you go through makes you stronger, and you appreciate things in life a lot more. And if it wasn't, for me, seeing my dad go to work, working 12 hours a day, going to the distribution center he had in like Bridgeport, Connecticut, which at that time was just a ghetto, right? We had stray cats all over the place. We had to kick them out so they wouldn't come inside the distribution center. But I'd help him pick up pallets, load them into the truck. Like it was fun at that time. That was entertainment for me, right? We didn't have like video games. We didn't have you didn't have time to go out with your friends. Like you hung out with your family. You helped. You ate together. You talked, and he would tell me stories about his life, and he was an avid reader. So when I was young, he would tell me stories about George Soros, like how he broke the pound. He would tell me stories about the Rockefeller family, like how much wealth they controlled. He would tell me stories about the Rothschilds in Europe, and those are the stories that it's that attention and those conversations. Right now I feel like with a lot of my friends that have kids, they just sit in front of the TV. That's not bad, watch a game or spend time that way. But I don't think, I'm very grateful for, I did have a rough childhood, but, that time that was spent and the conversations we had, really motivated me indirectly. My mom wanted me to be a doctor, but then I always remember the conversations I had with my dad about these legends in investing, and he would also talk about Warren Buffett and how the guy was disciplined and he made himself out of nothing. And I know that Buffett was wealthy to start with, but it was just the fact that we had those conversations to begin with that got me to focus on this asset class. And I knew I would have to work harder than everyone else because I look different. You probably went through some of the same things, but those are the things that, I mean, there are various others, but like that carved my childhood. And in addition to that, I really got out of my funk in elementary school, middle school by playing sports. Whether it was basketball or indoor track or lacrosse, I was able to make lasting friendships. Was connected to people in the community that that knew a lot more than me about certain aspects of life, and was there. I think growing up here as an immigrant was as part of an immigrant family was a unique experience that my nephews and nieces almost don't have the ability to experience because things have gotten a lot better for them. But I notice they don't value the same things that I do. They don't necessarily value hard work for hard work's sake. And I'm not saying that's a good thing or a bad thing. It's just their parents are all doctors now, and they're all doing well, and they get utility out of different things. So I'd love to also hear your perspective on on that. And society is changing, and I think people are focused more on quick on a quick buck and easy lifestyle. Not saying that's even terrible, but I think things have changed so much, and I think it's also reflected in the market where everyone's trading options, and everyone wants like that dopamine boost.
No, and I will say, I mean, I think in hearing your story, I think what it is that you end up being a fighter when you see your parents as fighters, and your parents end up being fighters more often than not when they're immigrants because they have to learn the language, learn the culture. You're dealing with discrimination. So it becomes part of who we are as the next generation because children mimic their parents, right? And I always have a lot of respect for those that are fighting and counter the narratives against them because of whatever number of reasons. And I'd argue it actually makes you very good at Twitter, which we'll separately get into. But Okay, so I've seen a number of your tweets on the bond market, and you keep mentioning the church of what's working now. Now, I'd argue that there's two churches. One is the church of post QE3, which for me was the marker under which, as you alluded to, the US really started outperforming pretty much everything else. It became a FANG centric type of market. Then the church of this year, which relates to the hell that I've kept on hitting on persistently of equities and treasuries in particular acting the same in terms of the drawdown. I've made this point before, Jay, that shorting is not supposed to be profitable over a long time period. One of the reasons that I was making the argument that the end of the world is the bull case, and that's why we're probably going to have a melt up October 2nd, is as I kept on thinking about the past behavior of stocks this year in particular, the number of weeks that the S&P has lost money as a percentage of the year is around 64%. So if you take weekly data on the S&P, the number of red weeks this year is on track to being the most number of down weeks going back to 1931. And we're not in a depression. I look at that and I see all the sentiment being unbelievably bearish on Twitter. And it makes me think that people have been conditioned to think
And institutions,
stocks.
same
And
thing.
it's right, correct, exactly right. The reason I'm putting context around that is I always go back to this point. The opportunity always exists when the crowd thinks it knows an unknowable future. And the one thing that tops and bottoms have in common is overconfidence. I want to hear your thoughts on this big move that we've had in October, if it's just another bear market rally like what we saw from mid-June to August, or if this could go further just because it's seemingly nobody wants to believe it.
Yeah, that's a great question. So I will say that I'm not an economist. I'm not a market technician. I don't believe in squiggly line analysis. But what I will say is that I try to follow the data to the best of my ability. And I'm only following macro because it's informing my decisions about when to size up my special situation trades. And over the past 2 years, we saw what happened in 2018, and we were very cautious, going into this tightening regime. In fact, the Fed just got to 23 billion of QT last week. You can go to the New York Fed Reserve's website for everyone in the audience and, look at our holdings. And, that's essentially at a 92 billion monthly rate. And, going to what you're saying, Mike, yes, this has been painful. We had, a 38% drawdown in the Nasdaq from all-time highs. The S&P 500 seen, one of the biggest drawdowns outside of COVID since 2008. But what I would like to say is that asset prices are still near all-time highs, whether it's residential, whether it's private equity, whether it's precious metals, whether it is, you look at every asset class on the planet. We are still, the wealth we created is still far more than what we have lost across real estate and public and private markets. Now, some of that has to be mark to market. People still have to take losses on it. Given where rates are, things may have to be repriced. But what's interesting to me is that the reason why the Fed has had so much room, one, they're late to the game. They should have started to hike 6 months, and it should have been in a more measured pace. But they're trying to catch up to all the crazy wealth that was created, and then there are essentially four contributors to this kind of bubble-ish environment. One was obviously the 8 trillion of stimulus we had, not just the monetary easing, but also, the number of loan programs that were there to spur small business. There's 600 billion of PPP, mostly went to grift. Like if I just did a poll of all my small business friends, and there are hundreds of them, I would say that many of them even admitted to me that they took funds that they either didn't need or they never hired the employees, and I was pretty shocked.
By the way,
Because
on that point, real quick, I would say that's not uncommon to just the post-COVID period. There were a lot of stories in 2008 studies that showed that some of these stimulus checks or some of the stimulus was literally going to pornography websites.
it's just the scale was a lot different. If you look at like the size of this fiscal stimulus, so what ended up happening after 2008 was that the fiscal response actually wasn't big enough, and the central bank Bernanke with QE1, QE2, Operation Twist, QE3 had to make up for it. And, we were still doing QE. We were sending swap lines to Europe during the peripheral crisis. And I would say more of the easing, was from the Fed and less was from fiscal. This time around, the fiscal response was so big and our systems were so outdated that people were getting money, and all of that's been forgiven because how do you do it in a fair way? How do you go back and audit people? You don't necessarily know like who's lying and who's not. There are individuals who have 30 LLCs up. That's a whole another topic. But I think there is so much. I mean, you look at the number of $60,000 trucks that were bought, and talking to car dealers, like people were lying about their incomes. They had taken $100,000 PPP, like made $70,000 a year, and were buying a $60,000 truck. And that huge kind of mini boom in the cycle. All that wealth and the assets that were bought and that wealth that was created is going to take several years to essentially make its way out of the system. So when it comes to like the real estate markets, for example, we think that we are in like a 2 to 3 year type bear market. When it comes to equities, it's very hard to know when things will turn from, the bank. And I like to say that, because the Fed owns, more than 8 trillion of treasuries and mortgage-backed securities, they effectively, in one way or the other are the market, right? The MBS market is one of the biggest markets in the world. you know, the entire dynamics of that market, how insurance companies, mutual funds, hedge funds trade it. When you look at the weighted average life of these securities and prepays and the return profiles, like everything has changed, but it's still one of the biggest asset classes in the world. And when the Fed takes these big stakes in large asset classes that people invest in, it pushes everyone else out on the risk curve. So the Fed effectively is the market. And, the fact that that they're tightening essentially at some point, like I think what you're alluding to is they have to stop at some point,
Not
right?
not not necessarily. So I don't. This whole melt up argument I've been making has nothing to do with a pivot.
Well, this melts-up argument in the recent week, like so on our space last week, the reason why we said the pain trade was up was not because of the Fed. It was because of the fact that positioning. So we've had
Right,
over a
exactly
year
right.
to focus on positioning and big funds. I was just at the ABS East credit conference in Miami. There's over $1 trillion of capital represented there from insurance companies, the Japanese banks, Nochu, Japan Post, biggest buyers of AAAs. You had, the biggest hedge funds, BlackRock, Blackstone, the private equity managers. You had Cerberus, you had Bain there, you had the mid-sized managers like the Aramarks of the world, and all of them essentially were looking at how to allocate. And they had, all these managers have raised hundreds of billions of dollars for private credit, public credit, structured credit, and they don't know what to do with it. And on the corporate side, we also have cash as a percentage of like total debt, cash as a percentage of market cap at all-time highs. So there's a lot of cash on the sidelines, and individuals have a lot of cash as well. You saw like, that $90 billion that moved into money markets, right? People's savings, like there's in the higher wealth brackets, people still have a lot of savings. So what I was thinking is, okay, well, hedge fund positioning, you look at like the big tech funds, they went from like, you know, 85% gross, 30 to 60 net to like basically like 30%, basically 15% net, let's just say that. And most of them have hedges on. So you go into every big risk event, and after that event, you tend to have like some sort of a hedge covering. With OpEx, we have these 2 trillion, 3 trillion, OpEx events, every month, and you see some wild volatility around those events. But more important than that was that you have this Fed blackout window going into November 3rd. So you didn't have 22 Fed members like jawboning the market down during the week. And you also had a corporate buyback that was restarting. And because of this 1% buyback tax, I think this quarter you're going to have the most corporate buybacks that we've ever seen. Like look at AutoNation, for example, with a $6 billion market cap, announcing a $1 billion buyback overnight. And it's a cyclical business. It's a business that, we wouldn't necessarily buy. It looks like it's a 4 times PE, but it's going to an 8 times PE when earnings come down. But the stock is going to be held up in the short term because, the management team's putting in, maybe they're buying, 50 million a week of stock, so it's, so that was the pain trade. We are a little bit more cautious going into this Fed meeting because I tend to disbelieve this Fox News report that BlackRock is telling clients the Fed is going to pivot. I doubt that they would be doing that. But
But there are other things I think that are. So I go back to the path as what's been so unusual. So I know you've talked about risk parity, right? And as much as
yeah,
people,
isn't Bridgewater all weather? You would know this more than I would. Isn't Bridgewater all weather down like 30%? Isn't this
right,
one of your worst years?
right, and that's I'm mentioning that because the same dynamic that has destroyed risk parity this year is the same dynamic that was my hell, which is that the risk off treasury interaction against equities failed. Right, first time in history in a big drawdown where treasuries have lost more money than equities in a high volatility sequence. And I always go back to this point that saying that bonds and stocks are both due to lose money is different than saying how treasuries and equities lose money in the path of losing money. So in the case of risk parity, as you know, right, you lever up treasuries to normalize the beta of equities. You've got other asset classes in there. In theory, over time, one of those asset classes will work. It's actually a very sound concept. This is just one of those very anomalous years, not just because of the drawdown in treasuries against equities, but again, also in terms of that path, number of weeks down for the S&P, number of weeks down for treasuries. Now, on that point about the bearishness, and again, the sequence thing, here's why I think that this could continue to surprise people, at least in the short term. You and I both know the saying, right? Staircase up, elevator down, right? Because markets are very good at breaking the illusion of consistency. The illusion is the staircase keeps going higher. Oddly enough, this year it's been staircase down, right? In other words, the consistency, which is very bizarre historically, I've looked at the data in terms of past behavior. You never have a year where it's playing out in this kind of move, which to your point is what has conditioned institutions to also be negative, to have cash. So what if you end up having the elevator up this time, right? Which would be very counter to history, but everything we've seen so far has been counter to history. And that's not necessarily an argument for an end of the bear market, because we'll talk about it. I'm with you. I think this probably lasts for a while. But it just seems to me that there's this really interesting setup in the way that stocks and bonds have acted.
Something you said was really interesting to me. And, it's been on my mind throughout this entire conversation. And I think the one thing that you said was, when people start making like grandiose statements and assuming that, this market is going to last for 10 years, that's when you kind of have to start thinking the opposite way.
Right, right.
So when we had 140 SaaS IPOs and every SaaS IPO was calling itself a monopoly, and every fin Twitter, and I'm not saying they're all good people, but every 20-year-old fin Twitter was saying, I'm the next Warren Buffett. I'm buying these SaaS monopolies that don't generate any free cash flow or any way of funding themselves outside of outside of equity markets. When those guys started to blow up, they were completely shocked. They were like, how could this happen? We read through the prospectus. This is a good company. We don't know. We like our minds are exploding. In the same way, I'm seeing people now saying we're going to be in a depression for 10 years. Everyone's going to die. You're going to lose
Louder,
your
louder.
home.
Jay, I'll tell you, and I think this was the whole thing about the Armageddon I was saying. I said the end of the world is at hand, which is why a stock market meltup is about to take place, because you could see it. And it's funny because I used to write for MarketWatch.com, used to be one of their top writers. And whenever I would put out a piece that was contrary to a prolonged downtrend, right? People would literally just outright insult me in the comments, not even looking at the
Oh,
analysis.
dude.
Just,
I mean,
dude, right?
I
And you see it
remember
yourself, right? To be
like
personal.
Yahoo Finance message boards during
Right,
the
exactly.
friggin' tech bubble. People,
Right.
you guys think Twitter is bad. Like people would call out like your relatives with
Yeah.
expletives. Like this has been like people have been nasty. As long as when you don't have your real identity online, people have been nasty since the beginning of the internet.
Right, but my point is that because I've seen this before, this is not something you can backtest. This is more just me subjectively saying that when you see people going to that extent, you know that you're probably about to be right, because the people are so entrenched in an existing view because they're conditioned to think that way, right? And it's often the fringe where you see the what the subconscious average is thinking.
Do you know
Right?
what the interesting thing is there? That like on the treasury side, right, we took a position. When the UK was blowing up, our position was that, especially because there were some hints out. It's not like we just came to this novel idea. Our view was that they would clean up the fiscal. We didn't know it was to this extent. And to save the $2.3 trillion pension system, they would raise rates and reduce the amount of stimulus in the economy so that the fixed charge coverage ratio went from 1.8 to 1.2. The UK government, it would go back up above 1.5 and bonds would come down. On that thesis, when treasuries blew out, we didn't buy treasuries on the Fed pivot thesis. We were like, hey, developed market 10-year bonds and 20-year, 30-year bonds are blowing out. Let's buy TLT. And we bought it all the way down, from 100 to 91, and then started trimming at 97. And it was because people were like, I was listening to Spaces podcast, institutional managers saying, oh, the treasury could go to 5-6%. And I was like, yeah, it's possible. But do you realize at
What that
6%,
means, right?
you realize how many companies I know where they would start breaching fixed charge ratios and would just
Right.
go bankrupt because they can't pay interest?
I'll,
Like, you
I'll,
have
I'll
no
take that a step
idea
further.
what you're talking about. Like,
I'll take a step further because this is part of that Armageddon situation. I did a CFA Virginia presentation. It's available on YouTube. It's the clip on my pin tweet is from that discussion. I basically made that argument, right? If yields, people seemingly, I'm sure you've seen this too, they look at bonds, treasuries in particular, and they think it's like a stock. They think it's as important as stocks. So here's why this was, at least to me, October 2nd, sort of a do or die moment for everything, literally everything. Because if you were to extrapolate out the speed of the rise in yields in 30-year treasuries, the way that they had been playing out and the way they actually continue to play out in the weeks following, you would probably have 30-year mortgage rates at 20% next month. I mean, it's about the speed, right? The volatility of treasuries.
right. And not only
Right.
that, you had like Fannie Freddie Met spreads blowing out. You had MBS spreads blowing out.
It's the end of the world.
So you have 7% mortgage rates, where if the 30 years at 4, that 300 basis point spread is also the highest we've seen.
Right, exactly right. And I made that point too. It's like, all right, so that 300 basis point, if you're going to argue that 10-year yields should be at 5 or 6%, that means they probably have to be at 10 or 12. Because then at that point, you also have to price in default risk by the U.S. government.
Well, I don't want to go into that because I have to think about that. I haven't thought about that in as much detail. But what I will say is that you would see just you would see hundreds of companies in the private markets blowing up, and that type of pain is irreversible. So I would like to think that you know Powell and Bernard and Daly and all of those guys are smart enough to realize what's the difference between lowering inflation and creating permanent damage in the economy. Now, you might say, well, 28% of the high yield market is zombie companies that only exist to pay off their debt, and maybe they don't deserve to exist. But I would frankly say that all those companies employ real people, and all those companies, wouldn't have even though they existed in a low interest rate regime, they still serve a purpose.
So another interesting thing about that is if you end up having these mass bankruptcies, which everyone calls for, right, to flush the system, what do you think that does to inflation when you have less competition?
Exactly. All these companies start raising prices on you, and it's a fine balance. And I do think that I don't think people understand how important the credit markets are and how big this type of shock is. Like, you think of like the average. I'll just give you an idea of like the average MBS investor. When you think about this asset class, the reason why I'm talking about it is very few people understand it. This asset class has gone from like a 4-year duration asset class to a 10-year duration asset class. Because historically, like in 2020, 2021, a mortgage bond is essentially, it's a wrapped bond of essentially Fannie and Freddie, and sometimes Ginnie Mae mortgages. Essentially, you hold these bonds for yield. They're fairly, low risk. Spreads were under, 50 bips at one point during COVID, and you get huge amounts of prepays that you recycle. So there's a huge ecosystem around MBS investing. Prepays are usually around 16, 20%. During COVID, they went up to 36%. Because the rates were so low, everyone was refinancing their home, buying new properties, et cetera. That whole ecosystem has shut down, right? With prepays this low, all the mortgage bankers, the traders, bankers, this entire market, is completely frozen. There are thousands of people being laid off because that cash that's coming into prepays isn't there to invest. There's an entire, for financiers, there's an entire ecosystem that works around reinvesting that capital, that's completely stopped. And the mortgage underwriters aren't making money, so they're going to have to charge more. There are reasons why there's like a huge spread of 300 basis points. But, when you think about why mortgage rates are at 7.1% and why, 30-year treasuries at 4%, these changes in interest rates may not seem like anything to the individual investor, but they drive, entire asset classes in really big ways. You look at the housing market. The housing market employs, over 11 million people and up to 30 million people when you think about, all the tangential areas it works with, right? The HVAC suppliers, right? The hardware stores, the roofers, And all those people and their supply chains, it's a huge market, and that market is going to slow down very precipitously. The effects of what the Fed is doing aren't going to hit the market till 12 months from now.
Right. And real quick, that's why my right eye is lumber. Is people get up, they say, why am I so obsessed with lumber? Because of housing. Housing is the driver. Lumber is the leading indicator to housing. Right. This is, it's funny you said, if you understand this, because I often jokingly say that sarcastically, but I think you're right. I think most people really underestimate. So I shared in the nest just because it was kind of funny to me. I've been saying, Jay, since like March, April, this environment's worse than '08, worse than 2020. And some people still think I'm crazy having said that back then. People will come back at me and say, well, you haven't had a single company go broke or go default. You haven't had anything like rates, right? But you almost had the
You
entire
had a few
UK go under.
bankruptcies, but nothing like
Right, but you had almost the entire UK go under a few weeks ago. Right, but you alluded to a little bit earlier also the mark to market side. I don't know I don't think people really do have a handle of how severe the losses are, because a lot of the collateral is not mark to market in institutions across the globe.
That's right. Like banks, for example, when you think about pensions, right? Pensions aren't publishing quarterly statements. We don't know how much money they've lost on U.S. Treasuries and how that's going to inform their decisions, to invest in. And they also have huge, obligations to invest in private equity and venture capital, right? Those funds tend to draw down when they find an investment. So they have huge obligations. So they don't have the liquidity that you may think they have when you also factor in, the mark to market. And some, are sophisticated, they hedge, they use interest rate swaps, et cetera. Some don't. But I don't know. I think this is different. I don't know if you can actually compare it to 2008, because in 2008, I had, friends that were out of the job market for, 3 to 5 years after '08. Some permanently retired. You had just rampant fraud throughout the real estate market, which is one of the biggest parts of the US economy, and banks just weren't adequately capitalized. So I do think in some ways it was worse. I think this time the part that's worse is that there's, with treasuries and equity selling off at the same time, it's worse for investment managers because they're like, okay, well, what do we do? And not everyone is nimble enough to, to look at some of the 500 million type special situations and, SPAC shorts that I'm able to look at. When you think about how the investment landscape is set up, most funds are down, and they would have had no choice. There's no way to set up in a way where you wouldn't be down without taking excessive risk.
Right.
Even financial advisors have an investment policy statement, and it kind of guides
Right.
how they invest on your behalf. So, for example, if you have a hedge fund that focuses on tech, right, and they have a specific mandate around what they can short, how they can hedge, right, you're just shit out of luck, right? You're a long tech investor, and what tech company? There are a handful of them that have outperformed, but what tech company has outperformed? So, there's some, a lot of mutual funds that have benchmarks. They have to be down because they follow certain benchmarks. And, with hedge funds, you can be more nimble. A lot of hedge funds don't hedge, which is really funny, but in some overhedge and blow up. But, when you think about mutual funds, yeah, I will repeat that. Mutual funds often follow benchmarks, and there's certain rules around how they manage their capital. So, they get paid to outperform an index. They don't get necessarily paid or rewarded, and their docs don't allow them to do things outside of that. So that's something important to understand about the asset management industry. One of the reasons why I left the asset management industry is like those rules, the compliance, the red tape is just something I didn't want to deal with anymore.
Yeah, you want flexibility, of course, for sure.
Exactly.
But I want to. So let's go to the name of the space. I kept on changing the name of the space a few times. Everybody here, by the way, please make sure you follow Jay Singh and check out his research and check out his spaces. I'll be trying to join them, Jay, every now and then. Also, so I renamed this to the crash that follows the meltup, because people seemingly think I'm calling for all-time highs or something like that. I'm not calling for anything.
Oh no, not at all. But
right. But let's talk about this, because let's play it out. Let's say you have a shock move higher. I don't think it's over. We'll see, right? And then you have another wave lower because, to your point, the damage is done, right? The economy is going to feel these high rates. Most consumers are not aware, right?
Earnings are going to come down faster in the next 2 quarters. It's going to be a shock to a lot of people because the U.S. economy is held up better than the rest of the world.
Right. So let's play that out now. If this is all about the asynchronous timing of the economy and rates, okay. One, I can argue to everybody here that the Fed may have already overshot, for all we know. Because again, it's like everybody keeps on saying, it drives me crazy to no end. They say you have to raise rates to be above inflation. to me, that's nonsense
No,
because
I don't think that's right either. I
right,
think they're just I mean, when that happened in the 70s, the demographics were completely different. The US was a manufacturing economy.
right,
Like
right,
comparing those, it's really apples to oranges.
correct.
I don't think we need to have, it's just arbitrary. It's like saying, look at the RSI. When the RSI gets to this, you buy the stock and you buy a company that's burning cash and you blow up. Like there are a lot of just like these heuristics,
Correct.
shortcuts, and biases people have that just you can't just assume that they're laws.
No, that's exactly right. Now, but then this is, and I want to hear your thoughts on this. The question in my mind is something fundamentally different in the perception of treasuries as the quote unquote safe haven,
Yes,
right?
there
That's
is.
at the core the question, right? Now, if there is, the question becomes how bad can that be in the sense that, so I've made this point before. You look at the top 20 biggest drawdowns for equities, 10 out of those 20 times treasuries make you money in the midst of those equity drawdowns. 9 out of the 10 times, which include a lot of periods in the 70s, treasuries lose money, but they lose a lot less, right? Which is still fine from a portfolio
Absolutely,
management, risk management
absolutely.
perspective. So the question becomes which is more likely to be the behavior on a go forward basis? The idea that treasury yields drop when stocks drop, or the idea that they rise, but rise at a much slower pace as stocks are dropping harder?
So that's a great question. I don't think anyone has the exact answer to that question. But secondly, using judgment, and I think, just to the audience here, using common sense and judgment is like the most underrated skill on FinTwit. But going back to, first of all, in treasuries, we're at an unprecedented time where, you can open up an account in Treasury Direct and you can buy as far as August 31st, I think the rate's ratcheting down. You can buy 10,000 of I bonds at 8.2%. You can put 50 grand if you have 3 kids and a wife or a partner, and put 50 grand into this 8% asset class, which is essentially risk free. You can buy 1 and 2 year treasuries above 4%. Like when in the last 15 years could you actually do that? So there are still things to do. There are still ways to preserve capital and earn, a I would say a meaningful return, a risk-free return. And yeah, you're taxed on federal, but not on state. And there are money markets today that will pay you 4% for 3 years. Like there are still also long and short opportunities and other things that will work. But going to your question on how we will, weather the storm, I think one of the reasons I think there are 3 reasons why treasuries have underperformed. One, the biggest buyer of treasuries at this time, the Fed, and the second biggest buyer, one body buyer, Japan, are both selling. And US individuals and banks can't keep up with the pace that they're selling. Now, you saw that in one day, the Bank of Japan, and there's going to be a regime change. So something could change by March of 2023. Kuroda's out. But at least going into that period, Japanese own 62% of the JGB market, and they're selling their reserves, their other asset classes, to essentially shore up and buy JGBs and support their currency as well. So the Japanese yen has fallen like 30%, and it breached 150. And I've seen every single day in the futures overnight. When I'm looking at futures, I look at the yen and it looks like it's being artificially supported, and they're just burning money into thin air to support the yen because one, they don't want hyperinflation. Inflation has gone from negative to 2.9% in Japan. I mean, they're getting what they want, but at some point, they need to be careful of how fast they go from a deflationary environment to an inflationary environment because most of Japanese savers are very conservative and they don't invest, and they're actually going to be losing 2.9% because their money's invested at zero. So I do think that Japan is a big part of it. I think, China's a part of it. They're no longer a buyer. I think that Europe, because, Europe and Japan, because of FX volatility, you look at adjusted, FX volatility adjusted investment in US treasuries, it becomes a lot less interesting. You look at currency FX is just so high right now that for them to buy US treasuries without any idea of where the floor is like something that I don't think anyone's ready to do in a big way. So I was actually talking to a friend who is close to Nochu, which is one of the big Japanese banks. What they were saying is like, they will get back into the US Treasury market. They just don't know what the level is, right? And if, a big bank like that is able to admit that, I don't think we can admit that either, but those are actually two separate reasons. The third reason why is that we're in like a once in a generation type inflation regime. I tend to think that, the goods inflation part of it is completely transitory. The service side may last a little bit longer, like 7% of core CPI is kind of sticky, wages, rents, but you're actually starting to see rents start to decline in certain parts of the US. You're starting to see real estate prices in the Bay Area down like I think 9% since May. So the real estate market and the rent, the pace of rent increases will increase. OER will have like, it'll optically look like real estate prices are still going up in the CPI and the PCE. 16% of the PCE is real estate related and 32% is that in CPI. But if you look at forward-looking indicators, I think that market is going to slow down as well. So you have a once in a generation inflationary shock because of a pandemic that no one had foreseen. And then the fourth reason I think is, just the impairments that a lot of funds have had, right? Like how much incremental buying power and do they have to buy? And when you look at the banks, like the treasury, there's treasury market illiquidity. The banks are like kind of hesitating to buy treasuries in a big way as well, even though for them with the capital treatment it's a great trade today. So that's why Treasury Secretary Yellen, in the poll, I think they have a meeting on November 1st as well, but in their August meeting they're actually talking about buying off the run treasuries. The last time they did that, I believe, was in 2002 from bank balance sheets. So, if you look at a treasury auction, let's say there's a 5-year auction and the rate, the bond comes at 4.33%. And, there are bonds on bank balance sheets, that are very liquid and might be at 4.5%. So there's actually an arbitrage to do there where the treasury could buy the bond at 4.5%, finance it with bills and, collapse that and make the arbitrage, right? But the treasury and the Fed are separate entities. The treasury would have to be using, capital that it has earned over the years to make those purchases. So it's not really QE, but it's almost like, an Operation Twist. So the Treasury would be buying bonds at the same time that the Fed would be allowing bonds to roll off the balance sheet. And our balance sheet's just gotten so big that, this is the first hint that, the Treasury and the Fed, understands this. And you're also seeing like 11 billion at the SMB. Now, why is there $11 billion using swap lines for the first time in 2 years at the Swiss National Bank? I think that, that the government is not dumb. They're not going to take us into a depression. And there's certain hints that, are saying that they're aware of issues. But the treasury market is where it is because, the biggest buyers are not buying. There, there is a once in a generation type inflation. There's illiquidity and hesitancy amongst big players on the other side to buy. And you didn't see that at any other point in time. So I still view, the US dollar as a reserve currency. I still view, the US economy and the government has the biggest asset class in the world, right? They have the net present value of corporate taxes for the best corporations in the world. And they have the net present value, right? And they prime you, right? It's better than equity, right? They essentially have the net present value of the tax stream from the wealthiest country in the world. And that asset, depending on the rate you use, I think well more than covers the amount of debt we have in the market. And frankly, this high inflation is helping the Treasury because it essentially is an inflation tax on everybody. In fact, more so on the poor, where if you assume, and I'm not saying this is going to happen, but let's say you assume you had 10% inflation for 2 years. Well, guess what? In relative terms, your debt is lower by 20% as well. And you paid it down, or, it fell at a faster rate than in any possible scenario of you paying it off. So just some interesting food for thought. I do think that at some point, the US is the best of the worst. So the fact that Italian 10-year and the UK 10-year, are materially lower than the US, we were continuing to buy longer term treasuries because we were like, hey, in the long term that just doesn't make sense. And at some point, there's going to be this illiquidity risk is going to go away. The Fed is going to have to slow down on the QT side. They're going to have to at some point the dot plot will stop going up. It's not going to be in November in our view. But it's kind of like those same people that went super bullish on like unprofitable tech. some of those same people today are saying, hey, we're going to have inflation for 5 years. And, I just don't see that. I don't see that happening. And there's just some simple common sense things you could think about, right? Like if real estate prices, fall by 30, 40%, I'm not saying that's even close to what's going to happen, but if it's going to happen in Canada pretty soon. But think about that. Think about the impact that has on cap rates. You frankly don't need to raise rents, very quickly to start making money on incremental purchases in the multifamily space, right? And then you have when unemployment rates go up, multifamily managers that own these properties start to compete against each other because their utilization gets lower, and then they start lowering rents. Like the market corrects itself. It's not like, it's not, there's never a scenario where you don't have a cycle, where things just go the same way forever. So, I think this US Treasury situation, I think the long bond is going to be one of the best buys through the upcoming recession, simply because there's going to be nowhere else for people to go. And one of the reasons why it's been held up is the US economy has been strong. And because the US economy has been so strong, the jolts came in, but we at one point had 2 jobs for everyone looking. So when you think about that, and you think about the $7.5 trillion of residential wealth that was created, and all the PPP money in the system that the government knows they overdid, and you come to a point where the government's like, all right, we need to correct our mistake. And guess what? The US economy is so strong and people have made so much money, we can do this for a couple years. And it won't be like '08 where people like lose their entire net worth. Like, listen, if they had a 20% down payment in a home in 2018, that home appreciated like 30-40%. If real estate prices fall 15%, they still built adequate equity in their home. The world's not going to end.
Right.
And the S&P 500's tripled since the financial crisis. People lose like 20-30% of their 401k. It's also not the end of the world. The Fed has to signal that they're going to pause before foreign capital comes in. At least that's what I've heard from the Japanese banks. I'm sure everyone's kind of thinking the same way. And when you do see that move, you could probably see like a 50 bips tightening in a week, right? Or more.
On the long end, yeah, it could be even more aggressive. I mean, you can't. Yeah, the thing is, historically, when treasuries outperform equities in these highly volatile sequences during those flight to safety trades, you can get 2,000, 3,000, 4,000 relative basis points against stocks in a matter of weeks. I mean, there's a convective.
Just look this past week, right? We had really bad earnings from tech. We had the UK solve its problems, so that blowout risk was gone. And we had, I don't know if anyone even looks at this, but you had like the quarterly GDP related inflation measures out that were benign. And then you had PCE that was,
right,
a little bit lower than expectations. And all of a sudden you had the long bond, go from 4.37% to 4.06%. Which is a huge move. Like that was like 6 points on TLT, and outperformed that. Well, if apart from Friday, if it wasn't for Friday, it would have outperformed equities.
Right. No, and I think that's sort of that is what unfortunately people are not realizing. You talk about cycles. I'll just end with this. The number one thing I'm convinced of that plagues FinTwit is recency bias. Everyone constantly is extrapolating the short term, even when it's very clear you're in an anomaly, and thinking that that's going to persist. And this is why I go back to overconfidence by the crowd is often the thing that you want to go against, whether you're bullish or bearish. Do the opposite of the extreme mentality. Right? I think and I still think we're in that, but we'll see. Listen, I have to hop. I'm going to make this again for everybody here an edited podcast. Please make sure you follow Jay Singh here on Twitter. Jay, I'm going to send you an email. I have some thoughts for ways that we can collaborate separate from this. No, and I think this was a phenomenal conversation. Jay, as you can tell, is very thoughtful and very knowledgeable, and have a lot of respect for those in the arena, like Jay is, and hopefully, as some people realize, I am as well. Thank everybody for joining, and enjoy the rest
Just
of your day.
just the last comment. We are going to talk about earnings. We're doing a Sunday space, public space, free for everyone at 6:00, and we're going to talk about like the earnings divergence as well. Everyone talks about big tech, but look at Honeywell, Caterpillar, Gilead, IBM. The boring companies have actually, McDonald's, Pepsi, have been able to pass inflation on, and a lot of companies have beat in very big ways. We'll talk about whether that's temporary, what our views are, and some of the divergences, and why these earnings divergences have kept vol low, and have helped keep the market higher, right? Including the bank earnings at the beginning of earnings season. So we'll see you tomorrow as well.
Very good. And if you tweet that out, Jay, I'll retweet it. So thank you, everybody, and enjoy the rest of your day. Thank you, Jay. Cheers.
Thanks. Cheers.